Okay, good afternoon, everybody. It is 12:02. We've got a couple latecomers come in, and we're just letting them in at the last minute here, but we wanted to welcome all of you guys to our webinar today. It's the first webinar we've had with a guest speaker. I wanted to introduce Andrew Gay. Andrew, I'm sorry, I don't have like a formal intro of you. I'm just going to talk about you the way I would talk to most of my clients about you. So Andrew and I share 20 clients. I did a little research today. We have 20 clients that we share. Lilyfield does the bookkeeping for them, and Andrew does the tax returns for them. And it's been a really, really great working relationship between the two of us. When I first started my firm, I reached out to different tax accountants because that was kind of the way that I knew I could build my business. And there were very, very few that were willing to use QuickBooks Online or knew anything about it. And so, at the end of the year, they would ask me to email them a profit and loss and a balance sheet. And I just kind of felt like that was really old school. And then when I met Andrew, he was the first one that was like, wait, you can just invite me to their QuickBooks and I can go in there and pull the reports whenever I want. And I was like, yes, it's revolutionary. So that's kind of how we met and have developed this relationship over the years. And with full disclosure, I want to also let everyone know here that that Andrew is indeed my personal tax accountant as well. So any questions about that, you can put that in the chat. So with that, Andrew, I really want to welcome you. We are glad you're here. As Aaron put up, we're going to do the little fine print. This is not legal or, legal or tax advice. This is just an informational webinar here to answer your questions. So Andrew, if you want to say a few words before we dive in.
Sure. Yeah. Obviously, tax is an ever-changing landscape, and we anticipate, regardless of what happens in the November elections, there being tax law changes effective in 2025 with the 2017 tax changes expiring at the end of next year. So it's an exciting time to be in public accounting, and I expect 2025 to be a very busy year for Grimsley & Company with those tax law changes, in addition to taking care of our great client base. So I'm happy to be here today, and I appreciate you having me on, Katie and Aaron and team. So thank you.
Absolutely. So we're going to go ahead and just do a really, really high level tax overview so that we're all kind of coming from the same place. And again, if you have any questions, you can just go ahead and put those in the chat. And we'll kind of monitor that if they fit in, and then we'll definitely have Q&A at the end. So basically, we want to just do a quick overview of the different business structures, because based on how your business is structured is reflects how what type of tax return you're going to have. So if you are a sole proprietor or a single member LLC, you're going to have a Schedule C on your personal tax return on your Form 1040. That Schedule C is just going to be your income and the expenses for your business, and then that rolls right up into your tax return. Now, if you're a partnership or a multi-member LLC, you're going to have a separate tax return called a Form 1065, which is a partnership return. And then that will issue a K1, and then the K1 goes on your personal. And then for our S Corp folks, which we have a lot of, that separate return is actually a Form 1120S. And again, that also issues a K1 that's going to go to that personal tax return. So those are kind of the different types of business structures in the tax form that your tax accountant's going to fill out for you. Now, one of the questions that we hear at Lilyfield all the time, and I'm going to kick this one over to you, Andrew, is when should I become an S Corp? So when should I take the leap from single member LLC or multi-member LLC into an S corporation?
Sure. So it's a very common question, and I think leading into that, one of the important discussion points is self-employment tax and how that impacts these various entities. And so a sole proprietorship, just very high level, very quickly, on your Schedule C, you pay federal income tax and self-employment tax on the net earnings that come to you via your Schedule C or your sole proprietorship. In a partnership, self-employment tax is paid on the earnings from that partnership. You have guaranteed payments as an owner in partnerships. If you are doing something that would be above and beyond what your partners are doing, you would incur self-employment tax on that. Partnerships, Form 1065, if you are an owner, do not do a W-2 for yourself. That is not, that's a common mistake that I see. And then, of course, at the S corporation level, the owners of an S corporation, we do a salary for them. They have an actual W-2, just like if you work for somebody else, and that's where you pay self-employment tax on the wages, and then anything else above and beyond that is taken as distributions. So the new popular trend in tax today is that TikTok videos and all those things come out, and it's like, you need to be an S corp. If you're not an S corp, then you're, CPA doesn't know what he's talking about. That's not necessarily true. Okay. What I always tell people is the IRS says that you have to have a reasonable salary based on numerous factors. They leave that gray for a reason. Some of those factors are what you would have to pay somebody else to come in and run your business for you. How much money are you overall earning within the company? Versus, they don't want you taking $500,000 out in distributions and doing a $50,000 salary. So typically your net earnings through your S corporation or through your entity before you elect S needs to be $100,000 or more net, not gross. Okay. So once we are consistently moving forward, making $100,000 a year in net earnings, not gross, then that's when the conversation makes sense to talk to your CPA about an S election. The reason being is because you are effectively saving self-employment tax. Okay. So the example I always give is once I start earning $100,000 net, if I am a sole proprietor or a C corp or a Schedule C, then if I earn $100,000 that year, then I am paying federal income tax on $100,000 and Social Security Medicare tax on $100,000. Okay, self-employment tax and federal income tax on $100 grand. If I am an S corporation, I have to designate my reasonable salary. So the simple example is once I have that $100,000 of earnings, I can set my salary, my W-2 wages to check the box of my S corporation status at $50,000 instead of $100,000, and I can take the other $50,000 as a distribution. Now I'm only subjecting myself to self-employment tax on $50,000 as opposed to $100,000. So that's where the savings comes in, and obviously the more money you make, the more savings you can have on self-employment tax up to the Social Security max, and then Medicare tax to infinity. So that's where the savings comes in. It has to be offset by you paying someone to file an S corporation return for you. So we want to make sure that savings is included in there as well to look at the cost differences.
Right. And another one I'll add to the cost is, like you said, the cost of the tax, a separate tax return that you've got to have for the S corp, but also you've got to put yourself on payroll. So if you haven't been on payroll before, there's going to be costs associated with getting you on payroll and filing those payroll taxes on a quarterly basis and doing your annual filings at the end. That's another like kind of cost that people are like, whoa, I didn't know I had to do that.
Yep.
Awesome. Okay. All right. You want to do the next slide, Aaron?
We have a question first before we.
Oh, we do. Awesome.
Yeah. So what about the savings of a portion of FICA on your personal return?
You want to say that one again?
Sure. So what about savings of a portion of FICA on your personal return?
Janet, and I assume you're talking about, so you will get, when you are the employee and the employer, you get a deduction for half of the FICA taxes that either are on your personal return if you're a Schedule C, or would flow through to you through the company. So any of the FICA taxes, there's an employee portion for half. It's 15.3%. Employee pays half, employer pays half. So when you're both, you get to take a deduction for half of that, either on your personal return or through the company. So the ultimate net tax effect of self-employment, which I think you're asking, Janet, would be half of that 15.3%. Anything to add on that, Katie?
No, not on that one, but our next slide, I probably should have done this one first before the structure. So we wanted to just kind of talk about the different taxes that a business owner pays. Because sometimes when we just use the word generically as taxes, people are thinking all different things. So we just want to kind of talk about the first one's the federal income tax. So that's the tax everybody pays no matter what. That's your Schedule 1040. You will pay that one way or another, whether you're a business owner or you're an employee. That's the one you're going to have to pay. The self-employment tax that Andrew referred to is a tax if you are a sole proprietor or a single member LLC. So if you file that Schedule C as part of your tax return, you will be paying self-employment tax. And that's simply because you don't have a paycheck. And this is the way that you can pay into your Social Security and Medicare. Then we've also got some folks on the call that are not from Florida. So we have state income taxes as well for those folks. And then we get into the employment payroll taxes. So every business, if they have payroll, must match their employees' FICA, which is your Social Security and Medicare. So the business owner has to match that. And then the business owner pays the federal and state unemployment to that particular state. Then we've got sales tax, which is just the sales tax on your everyday purchases. And then some municipalities or local, cities or towns may also have taxes on top of all that. So when we're talking today, we're really kind of talking primarily about the first three, with a little bit on the employment payroll taxes underneath. All right.
Okay. And we have a question about tangible property tax. So can we talk a little bit about tangible property tax?
Sure. So that would be an example, right, Andrew, of the local taxes, the tangible property.
Correct. Yeah. So make sure that you're in compliance with this. I mean, for Leon County, for example, it's 25,000 or more in tangible assets that you have in the company. You're required to file a tangible tax return. Those are due after extension time in early May. If an extension is filed for that, and they're the local counties are typically very lenient in allowing you just have to send in a letter or request an extension. But once you report those tangible assets, they start their own internal depreciation schedule on those assets and will bill you accordingly until those obviously run to zero. So it is important when managing your business to make sure that if you do get rid of a copier or another tangible asset within your company, that you are changing that or making sure your CPA knows that, to change that on the tangible tax return that's filed annually in the spring, because that is a way you could save on taxes by making sure that's removed from that tangible tax return, and the county stops taxing you on that. So it's important to pay attention. Every little bit adds up, and that's a way that you can really manage the local taxes through the tangible tax return.
Right. And most of our service-based clients don't even hit that $25,000 threshold. The majority of the assets they have are, desks and laptops, and so you just have to keep in mind that it's for tangible property is going to be machinery, equipment, anything that's going to be large dollar amount, and you keep track of that. And anything under 25,000, you're fine. But once you hit that 25,000 or above, that's when this particular local tax kicks in. Awesome.
Okay. All right. We wanted to then jump into what are some typical deductions you might see on your tax return that relate to businesses itself. So those office supplies and those pieces of equipment you're using under the threshold. Typically, we use a threshold of $2,500 in a purchase. You would just expense those as a business deduction. Rent and utilities you can deduct, travel and meals. There's some particulars on meals that we'll let Andrew speak to. Other costs like marketing and advertising, your home office deduction. Again, there's some particulars on that. We'll let Andrew speak to if you're thinking about using your vehicle for business use. There's deductions available around that, and some really good ones around retirement contributions as well. So we see the list. There's a lot to choose from here. Andrew, do you want to hit some of the highlights of each of these?
Yeah, sure. And pay attention to the bold at the bottom of keeping your receipts, document all expenses. I used to not be as big of a stickler on that. I did have a client that was audited out of the state of Florida, and the IRS agent only allowed her to be able to deduct expenses in which she was able to provide a receipt. It's the first time that's ever happened to me in my career. So it completely changed my tune on how important receipts are. Not credit card statements, not bank statements, actual receipts are very important to keep. So even if you just stick them in a box, and one day if I ever have to deal with the IRS for you, I can dump them out on the table and tell them to count it. But even if it's in that most simplistic form, it's very important. So at a high level, I always tell people, we want to identify as many things as you're incurring expense on in your everyday life and figure out a business purpose for that expense. We don't want to spend $1 to save 30 cents, but at the same time, to the extent that you're buying a computer or buying a meal, and business is discussed before, during, or after that meal, then that's an expense for business purpose. The IRS oftentimes understands that you're going to be aggressive with meals expense, for example, and so that's why they only allow you 50% deductibility on most of your meals. Now, there are exceptions to that where you can take 100% of a meal cost. For an example is if you have your staff working through a deadline, for example, and you bring in lunch to allow them to continue to work through a deadline, then that makes that meal 100% deductible. But if I take my client out to dinner or we have lunch together, and I pay for that at Grimsley and Company, then that meal to me is only 50% deductible. And so make sure that whoever is keeping your books is asking those types of questions, that if you've got the receipt there that you're noting, is that for a client? Was that bringing in lunch for your team in order to continue working throughout the day, a necessary meal from that standpoint? So those are things you want to look at there. In regards to the vehicle, that is another example of something that obviously we all spend money on. The IRS, when it is for business purpose, does allow you to put your vehicle as the owner into the company. We don't want to go buy $120,000 Range Rover now just because we can put our vehicle in the company. But at the same time, if we're going to buy a new vehicle anyway, and it's something we need, then we might as well go ahead and put that in the business. And the way that you do that is you title it in your LLC name, if you are an LLC, or your business entity name. And then we want to make sure that we have, for ease. And the biggest question I get is then the client calls me and says, well, I'm at the dealership. They're kind of giving me a hard time, or the bank's giving me a hard time on the financing, let's say. So I always tell people you can also title it to say the LLC name / your personal name. Okay. But the IRS, the check is going to be that they want to see that the entity is on the title. Okay. So even if we have to do Grimsley and Company CPAs / Andrew Gay, that's okay. And that may give you some ease in being able to get that done with the dealership. So forever, vehicles have been allowed to be fully depreciated. That changed this past year. And so now when you buy a vehicle, for whatever reason, the IRS pegs that to weight. If it's over 6,000 pounds, you can write off most of the vehicle all in 1 year. It's typically about 80% that it comes to that you'd be able to write off in the current year. And then if it's under 6,000 pounds, then it allows you to write up to, it changes for inflation. I don't know it off the top of my head, but it's around $20,000, $19,000 or $20,000 that you can write a vehicle off and then take the remaining depreciation over 5 years. So that's a big one that a lot of people maybe miss out on. And then once the vehicle is titled in the entity name, you take actual expenses for that moving forward as opposed to mileage. So mileage is another big one. If your vehicle's not in your company, to make sure that you're picking up on. retirement contributions. So the 401k contribution limit for 24 is 23,000. And then if you're 50 or older, you can put another 7,500 in to the 401k. So, you can do a solo K if you're a single employer. Then if it's just you can look at a solo K option. You can also do a SEP. But really, I always tell people, let's start with the easy, tangible things that we make sure we're really hitting the mark on. And those things are obviously what we talked about, which is identifying all these expenses that we can make a business purpose for, running that through the company. The second is looking at what we're doing with our vehicle. The third is what are we doing with our retirement, and then getting to a goal, not trying to do anything else fancy, but let's get to a goal where we can maximize our retirement contributions. And then the next one is health insurance. So if you have an HSA, that's a great tool for tax purposes, because you get a deduction for that contribution. Let's see, the 24 contribution limit is $4,150 for individuals and $8,300 for families. And again, they have a catch-up option of $1,000 for people 55 and older. And the beauty of that is you get a tax-deductible contribution, you get tax-free growth, and then you get tax-free withdrawals for paying your health insurance. Your health-related expenses. So HSA options are great. Health insurance for a business owner can be deductible as self-employed health insurance. So there's a lot of options there of making sure we're hitting on retirement, health insurance. And then a third, which doesn't necessarily provide the biggest tax benefits on an annualized basis, for like depreciation, for example, or maybe a large retirement contribution, is looking at buying your own building. So if you have the opportunity to occupy a space with your business and you don't fully, work from home, then I always tell people, in addition to the benefits of the expenses related to that building offsetting your business income, you also have an opportunity to build in sort of a pension or annuity or a retirement asset that your company can pay for while you own the company. So it doesn't have to be these big fancy things that you see on TikTok that are the aggressive tax tactics for you to be maximizing your opportunities. Those are basic blocking and tackling that can really add up for you if you're making sure you're maximizing those benefits.
Okay.
I saw some questions coming in too, so we can address those.
Yeah, I thought we'd get some questions on this one. So if you are traveling and you have to feed yourself when you're traveling, is that 100% deductible or 50% deductible?
If you are feeding yourself during travel, I believe that's only 50%.
Okay. Can you do a home office deduction if you also have a real office, an office you go in and work in?
If you have a real office and that is something that you commute to all the time, then the answer is no. You can't. But what you can do is, take some of those expenses that you're paying for at your home, like your internet and cable maybe, and your phone, and those things, you can make a business purpose for to use, but actually taking the designated square footage would not be allowable if you have an office to access in Jennifer's example. So we can still utilize some of those expenses. Like I said, the phone, internet, if we could make an argument for some, cable access, then potentially that as well to get some benefit for that. Will my SEP provider provide me an end of year statement? They should. And just so everyone knows, the SEPs are calculated off of your net earnings subject to self-employment tax. And so if you are an S corporation and you have a SEP, you have to make sure that your salary is set high enough in order to put the contribution amount that you want in. So it's 25% of your net subject to self-employment tax. So if you're a sole proprietor, it's driven off of what your net income is on your Schedule C. If you are an S corporation owner and you have wages, then you've got to set your salary at a high enough amount to make sure that that 25% of that is what you're allowed to put into your retirement. So There is some pre-planning that needs to take place if you are trying to manage and maximize your SEP, and that's either done through wages or through um, if you're a sole proprietor, then it's done through what your net earnings would be. So you'd have to have a pretty good projection of where you're going to end up in the year.
And Andrew, a lot of our clients are really focused on, their business growth and ensuring that they're, running their business focused heads down on the business. And we've talked about a lot of these, kind of technical items. How often do you recommend that our owners meet with their tax accountant so that they can identify these deductions and they have those strategies in place so they can maximize their benefits?
Sure. Yeah. I mean, it all depends on the person and how and who is managing their book. So, for example, if you're a Lilyfield client, Lilyfield does a great job of keeping you up to date where, throughout the year, you kind of have a very accurate picture of where you are. So I think that's a different approach than someone who's kind of just flying by the seat of their pants and not really sure how much money they made through the year. They just know money's coming in, they're paying things, but they have no idea how much they're truly making. And so, if you're in that first position, like I said, with Lilyfield, then, I have a conversation with clients when we do the tax return, and I try to make sure we focus on also the year ahead to say, okay, is there anything happening in this upcoming year that we need to account for? And try to build around estimated tax payments and planning at the time of the filing of the return. And then, towards the end of the year, I always tell people too, to call me if they feel like there's been a change in what we've discussed, so that we can plan for that accordingly in the October, November, December timeframe. So, I would say at minimum twice, unless, again, when you're dealing with someone like the advantage of the reason why I like sending my clients to Lilyfield is Katie and I have communicated a lot over the years as to what the expectations are from a tax standpoint and what is needed and what we look for. And so the great thing about the integration there is their team is super focused on identifying when there is a major trigger point to for them to give me a call or whoever their CPA is, so that we can make sure that planning is happening accordingly.
Yeah, that's one of our steps in the fall, usually August, September, October, we really have our managers start to look at year-to-date comparative to the prior year. And if there's a wild swing in either direction, we'll reach out to the tax accountant and say, whoa, this is going on. But also the other cool thing that we do is during the year, if there's a big purchase of some kind or an acquisition or a change in business structure, whatever it is, we document that so that we can send all that information over to your tax accountant at the end of the year and get that over to them as quickly as possible. So, Andrew, you mentioned estimated taxes, which is our next slide. So basically this is going to be your tax accountant at the end of the year. If you end up having to pay taxes, they're going to give you an amount that you should pay for the coming year. So when you get your, when you file your 2024 taxes, then your tax accountant should say, okay, here's what you need to file quarterly for 2025 in order to avoid penalties and interest. And that way you can stay on top of that and manage your cash flow accordingly. So there aren't any surprises at the end of the year. Surprise, you owe $25,000 in taxes. Where am I going to get that cash from? So that's what we do that for a numerous amount of our clients. We do it on their behalf. Other clients will pay in, on their own. But as Andrew said, checking in with that tax professional, for instance, he gave me my tax estimate, and then I knew come September it was too low. So I had to call him and say, I don't think this is going to be enough. And then we adjusted mid-year so that I won't owe a whole bunch at the end of the year, which has been really, really helpful. And then our last slide, keep detailed records. So we talked about that. I wanted to just show you guys. Here's mine. I literally have a folder and it says 2022 or 2024 receipts, and it's just full of receipts. I mean, that's literally what I do. And my thought process is, if someone's going to audit, if the IRS comes and audits Lilyfield, I'll pay my daughter, minimum wage to put those in date order, date and vendor order. So yeah, just, you've got to just have some kind of system for saving those receipts.
Yeah, and so, a couple things that just at a high level too, before we kind of open it up for questions and or go to any other slides, would be some things to look for as a business owner. When you are approaching year end and you're a cash basis taxpayer, obviously cash in, cash out affects when you are paying tax on that income or when you are getting that deduction. And so there is obviously timing at year end that you can build off of, and maybe there's expenses that you can prepay for a few months, or you can't help if a check comes in on December 31st and you're not there at the office. So those are things to look for timing for cash basis taxpayers at year end. Harvesting capital losses. Nobody wants to, obviously, if you have to harvest capital loss, then that means you've invested in a stock or a property and it's not doing well, and that's not good. And we want to see that through potentially. But if it's one of those things where it's like, I paid $200,000 for a small little lot in Carabel in 2005, and now it's worth $20,000. And we know that lots in Carabel, potentially, no offense to Carabel, are never going to go back to 200,000. Then that's an opportunity. If a year in which we have capital gains, maybe we've sold our business, maybe we've done well in other investments, that we could time those capital losses with those capital gains. That's something else you'd want to talk with your CPA about. And then just other things, like contributing to a 529 plan. If you have kids, the earnings grow tax-free, and the qualified withdrawals are now tax-free. And there's more qualifying reasons to be able to use those 529 plans if you have to, like private school or things like that. So and then the last one I wanted to mention was energy efficient credits for your home. If you're putting in a new water heater or an AC unit, make sure you're having the conversation with the vendor who's putting that in. If there are energy efficiency qualifiers that are reflected on the buyer's order, and you could potentially qualify for some credits there too. So just some other high level things to mention.
Andrew, I wanted to ask you, because a lot of the people on our call today, aren't clients of yours. And I wanted to ask you, I counted up in research for this, how many different CPAs that Lilyville works with. And we work with over 20 different CPAs. So we've seen the gamut. We've seen really loosey-goosey CPAs and really tight CPAs. How would someone know if they have a quote unquote good tax accountant or a bad tax accountant? What would be some signs to kind of look for?
I would say, a feel for consideration in your conversations or emails to make sure that everything is accounted for, so that there's some form of dialogue, either from like I said, email or phone conversation. Hey, do we have everything? Do we not? That shows, I always tell people, every return we prepare here at Grimsley and Company, I prepare it like it's my own. And so if I make a suggestion to a client, then it's something I would do myself. And so there's a line within the IRS tax code, and there's, knowledge is power, and knowledge of the tax code allows you to get, close to that line. But we will never put our clients in a position to where they would be in trouble for any position that we're recommending. And so I think, if you're a Schedule C sole proprietor, for example, and the CPA is not coming back and saying, well, what about auto expense? Well, what about your cell phone? Maybe there's some things we're missing. Then maybe it's just become a little transactional, and maybe it's time to look elsewhere. That's typically, communication is oftentimes the big driver of someone looking for a change.
All right, it looks like we've got some more questions coming in. Aaron, you want to kind of do those?
Okay, so as a single member LLC, how much should you put aside for federal versus self-employment taxes?
So in just very round numbers, it's going to, I mean, it obviously depends on how much money is coming in, but I would say a large majority, let's call it, are in the 15% bracket for federal income tax purposes for a sole proprietor. Plus you've got, in round numbers, 7.5% for self-employment tax. So to be conservative, I would always say between 20 and 25% as a single member LLC, you should be putting aside for federal and self-employment tax. And then you could pay that in estimated tax payments quarterly, so that you're not penalized. We didn't talk about this earlier, but you either have to pay in, if you ever hear someone say a protective estimate is 110% of your prior year tax liability. And so if you looked at your prior year return, you saw how much tax you paid, you multiplied that by 10%, then that's going to give you the number you need to pay in without being penalized, or 90% of your current liability. So as a rule of thumb, most single member LLCs, I say 20 to 25%.
All right, we've got a client who is in the first year a self-employed 1099. Instead of paying quarterly taxes, they opted to take advantage of 5% for 5 months. As long as there's enough funds to pay at the end of the year, are there any issues with that?
So not necessarily. A lot of people like to do that and prefer to do that. What I sort of say though is, well, now, because in Florida, for example, we're under a hurricane extension, so Q3 and Q4 payments are technically extended until May 1st of 25. I know that's hard to believe. But so there's not interest and penalties accruing on your Q3 and Q4 payment in a hurricane year. But the IRS obligation actually accrues right now at almost 10% a year. So even though you're taking advantage of the 5%, depending on a lot of different factors, which are what the prior year tax was, how much you have paid in this year through other sources, there still could be about a 5% variance accruing on any obligation you're not meeting in timely payment. So, you know, it's just a lot of times a comfort thing for people. They're okay with a few $100s in penalties, knowing they have access to that cash in case something bad happens. And that's understandable. So you have to, you know, there's a technical answer, which is there is a shortfall, but then there's also a non-technical answer that considers, you know, comfort level and, you know, ability to make sure you have some cash on hand throughout the year. So I hope that answers that question.
Okay. All right, we've got a crossing periods question. So if we've got a client and they mail a payment via check on 12/30 and it's received on January 3rd, does it get logged as 2024 or 2025 income for tax purposes?
If you are a cash basis taxpayer and you receive that check on January 3rd, then that is 2025 income. So that's, you know, like I said, you can't help if your office is closed for Christmas and New Year's and you're not receiving your mail, and you get it in and actually, you know, deposit it in January and you're a cash basis taxpayer, that's when you've received it. You didn't know if you had it or not. So I would side on the business owner and say that's 2025 income.
Okay. What level or income level threshold should our clients be reaching out to a CPA like your firm?
Sure. Yeah. So, I mean, we have clients of all shapes and sizes. But I would, you know, typically say, one, if you're a sole proprietor, then oftentimes, you know, taking advantage of expenses in consultation with a CPA can quickly pay for their services regardless of your income level. So if you're a sole proprietor or own a business, I would say, you know, really, you know, at any level, you know, within reason, there's an opportunity for savings. If you're, you know, just 2 W-2s and nothing else, then, you know, that's probably something you could go through TurboTax and save yourself $500 or $600. But the likelihood of most of the average sole proprietors would get, you know, at least a $400 or $500 or $600 savings or more in working with a CPA firm, even if, you know, they're doing $30,000 gross a year. So I would say, you know, kind of all shapes and sizes for the business owner. If you're just a W-2 employee, and your spouse is as well, then that's a different story.
All right. And then I think Michael's given us some suggestions about how to reduce our potential taxable income by paying for opportunities in this year, even if it's for next year events on a cash basis.
Sure. And that's a good point Michael makes. I mean, advertising versus charitable contribution, there's some leeway there, right? So if we are donating to an organization and we are going to have our company name and logo on that, obviously the bigger bang for your buck is going to be that to be an advertising expense as opposed to a charitable contribution. The reason being is a charitable contribution goes on Schedule A of your personal tax return ultimately, and the standard deduction now is almost $30,000, I think, for 2024 for a married filing joint couple. So that means your charitable contributions, your interest, your taxes, your medical expenses that exceed 7.5% of your adjusted gross income, all these things have to total 30,000 or more before you get $1 more of benefit. So you're going to get a much bigger bang for your buck if your company is advertised within this business, and this is an advertising expense as opposed to a charitable. So that's something you can keep a lookout for. And then I think we got another suggestion from Michael, which is good as well. Laptops and things like that on Black Friday for 24. And that's, again, same premise that Michael is referencing there, which is if we're going to spend money and we're a cash basis taxpayer on things we know we're going to need anyway and have to buy in January, February, March, let's go ahead and spend money on that in this current year and get the benefit now. The name of the game is always to kick that tax obligation can down the road. So.
Okay, I think we've got one more coming in. What's the typical charge or fee structure for a CPA to file an 1120S for an S corp?
So it all depends on the size. And I mean, for us in its most basic form, by the time we do the S corporation and do the personal return for us, I mean, probably our lowest costs are going to be probably around $1,500 for everything. And then it goes up from there based on size, complexity, and time spent. But there may be some single practitioner type people where you may be able to get something cheaper than that if that's not something that you're looking for. And so I would say that's kind of at Grimsley & Company, that's probably our bare minimum. But for an S corp return and the personal return and kind of any tax planning that comes with that, estimated tax payments and all that kind of stuff, and we that one time a year fee kind of includes, or it does include, if you call me in the fall and say, hey, we need to go through some planning, you're not going to get a $200 bill in the mail for that. I'm just going to talk to you about it and go through that. So there's a lot of great CPAs out there. That would be kind of the starting bare minimum range for someone, at our firm.
And just to give another plug to Andrew, since he's been so kind with his compliments on Lilyfield, the whole reason I chose Andrew to do mine, because for a long time, I was in the same boat as you guys. I was a single member LLC until I got too big, and then I became an S corp. And in my single member LLC days, I did do TurboTax. I was savvy enough to be able to navigate it. But once I did become an S corp, I was like, I'm not dealing with this anymore. Like once he started talking the words basis and stuff, I was like, I'm out. But what I really loved is that he takes the time to talk to you. Like if he will meet you, he will talk to you on the phone, he will meet you at his office, however you want to talk to understand, and you can ask him the question 5 different ways until you understand it. So, there's been multiple times where I'm like, I don't know what you're saying. And then he'll, give me some type of example or something like that. So when you're choosing your CPA, your tax accountant, that's what you're really wanting to look for. You're wanting a relationship type you don't want it to be transactional, like you said. You want it to be a relationship because you don't want to have to change tax accountants every single year. You want someone who knows you and your family and your business. And so that's what that would be my suggestion if you are kind of evaluating whether you either want to employ a CPA going forward or make a change.